Hello and welcome to this week's edition of Retire Well, the show that's dedicated to helping you retire well in all areas of your life. I'm your host, Kristen Oakley, and I'm joined by Kevin Bucher. He is the co-founder and a financial advisor at Citizen Advisory Group. And Kevin, I know we talked on the show a couple of weeks ago about taxes and how we could easily do an entire show on taxes. The reality is a lot of Americans are feeling taxed to death and have serious concerns about where our taxes are going. So we are going to get all into that today, aren't we?
Yes, and I know this is going to be a great episode. So I know maybe people don't love talking about taxes, or you might feel like there's not much you can do, but in preparation for this show, I wore my special jacket. So
do tell.
I know this is my special jacket because I've wore this on the show before and I get so many comments on it. So I was like, if we're going to do a show on taxes, I'll wear my bright jacket to really brighten the day.
I love it. I love it. And you brought some fun props too. So that's going to be great.
Yes. So that'll hopefully guide the conversation as we kind of get into some of these different topics. But going to your point, yes, I feel like we are taxed to death because I have a little list here. We pay sales tax. So when we buy goods and services, we pay tax.
Right.
We pay property tax. So when we own properties, we pay tax. We pay FICA taxes when we're working. So we pay into Social Security and Medicare programs.
Yep.
We pay federal, state, and city income taxes when we're working or drawing from a taxable account or pension. We pay capital gains tax on our investment gains. And then if that's not enough, on the way out the door, sometimes we have estate taxes, whether that's federal or state estate taxes.
Right.
So yeah, it's not just income taxes. We're taxed in all these different ways. We're taxed to death.
And we are taxed to death, and we're really feeling that squeeze too, I think, with recent events with inflation and everything else. Taxes are the one constant that don't go away.
Yeah, and I think a bigger question about taxes is where do we see them going? So when you look at the situation we're in right now, the reality is we can't really afford as a nation to keep our tax rates as low as they are today.
Yeah, talk about that, because a lot of people don't realize that we are in the third lowest tax brackets that we've ever been in history.
Yeah, so we had the Tax Cuts and Job Act of 2017. Taxes are really on sale right now when you look historically. But when you look out into the future, we have so many looming issues that could affect the future tax rates. And it's interesting when I do a tax workshop, and we talk a lot about taxes at our office and with clients. And I don't know that I've met with anyone ever in my 17 years of doing this that felt like, yeah, taxes will absolutely be lower than they are today in the future. So I think everyone has this expectation that, yeah, taxes are going to be higher in the future, but at the same time, we keep putting off and kicking the can down the road when we're going to pay these taxes. So, there's a lot of challenges out there.
Right.
We have $34 trillion of debt.
And counting.
And counting.
It's going up during the show.
$5 billion a day. So, I don't know if you're catching, but 34 trillion with a T, it's increasing by 5 billion with a B every day. We are now paying more in interest on our national debt than we pay to our national defense budget.
Oh gosh, when you put it that way too, it's just really discouraging.
It's really discouraging when you look at, okay, what is that going to mean down the road? So we've actually had a spending deficit every year going back to 2001. So we're still spending. And so they're going to have to generate some revenue to start paying these spending bills off and to start paying this debt down. So where does the government get revenue from? They get it from taxpayers.
Yep.
So when you look at the future of taxes, I think it's a pretty safe bet that taxes in the future are going to be worse, if not much worse, for many of us.
Right.
And even if we don't think that that's going to really affect us greatly, there is tax law changes that are coming in 2026 without them even having to pass any new laws. Because the Tax Cuts and Job Act of 2017 was not permanent law. That expires in 2025.
Right, the term we say it's set to sunset at the end of 2025.
Yeah, so that's going to sunset. So what does that mean? It means that right now we work under the 10%, 12%, 22%, 24% federal income tax brackets. When we revert back to the pre-Tax Cuts and Job Act rates, well, it's no longer 10, 12, 22, 24. It goes back to 10, 15, 25, 28. So we're essentially eliminating some of those more efficient. 12 becomes
Right.
15, 22 becomes 25. So there's a tax raise coming, whether they pass new laws or not, but it's probably just as likely that they pass new laws to increase taxes even worse than that.
And we call that legislative risk. I mean, really, a lot of us are playing a game when it comes to taxes that we've never been given the rule book to. And Congress, government can change these laws at any point at the drop of a hat. You have to be prepared for that.
Yeah, and I love that you just used that word or phrase, that playing a game. And maybe money or taxes and Social Security and Medicare and investments and all these things, maybe we shouldn't look at it as a game, but the reality is there is a game that's being played, and too often we find folks that aren't actually playing the game.
Right, because we haven't been given the rule book on how to do that.
Yeah, so that is one of the big advantages of working with a financial firm or financial advisor who does holistic financial planning with a fiduciary responsibility to their clients. And as a firm, we do holistic financial planning with that fiduciary responsibility to our clients. But really the bottom line is we do that with a compassionate heart of wanting to help people to play, and not just play this game, but to win the game.
And a lot of what you do to help folks win that game, to continue with that analogy, is to engage in proactive tax planning. So why don't you share with our viewers a little bit about the difference between tax planning, which is what you specialize in doing, versus tax preparation, which most folks are familiar with?
Yeah, so sorry, I almost laugh as you're explaining it, because I think if I asked a lot of folks, tell me a little bit about your tax plan, or how is your tax planning going? And the answer I would get is, well, I get a little bit of money back. Well, that's not really tax planning, right? So doing your tax return and then getting a little bit of a refund back is definitely not what I mean by a tax plan. A tax plan is more forward-looking than that.
Yes.
It's looking at your long-term tax liability and how to pay the least amount of taxes over that period of time. And too often, tax preparation, which is the exercise of looking backwards and doing your tax return, the emphasis is spent on trying to reduce or defer your taxation. So I'll pay the taxes later, and sometimes it just doesn't make sense to pay the taxes later. Sometimes it makes sense to pay them today. Going back to this example of tax rates are going to be higher in the future. They're here today.
Right.
Pay those taxes while they're on sale.
Right. Which is so important. I think a lot of folks, again, just aren't aware of the current season we're in and why this is such a timely conversation, because acting now, you can take advantage of this time of period where taxes are on sale, and we've got some time left to work with that, to plan.
Yeah, so here's a quick example. So for those of you that are still in your working years, one of the fundamental tax decisions you have is, where are you going to place your retirement dollars? So we'll get into this more in other segments, but I can put my dollars into the pre-taxed account and defer the taxes and pay them later, or I can put them in the tax-free account like a Roth or a Roth 401k. We'll skip the taxable bucket for now. But so a client example, John and Betsy, they're working today, and when we look at their current income, they're in the 22% tax bracket.
Okay.
So when they retire, they're fortunate that they both are retiring with pensions and a little bit of Social Security, so their income is still pretty high when they retire. They're still going to be in the 22% tax bracket. So as we're working with them, trying to make the decision about their retirement savings, do we put it in pre-tax and take the deduction now and pay the taxes later, or do we put it in tax-free? Well, if they're in the same tax bracket today as they're going to be in the future, why put it into the pre-tax? Why take a deduction today when it's going to cost me the same to get it out later, when I can put it into the tax-free, pay the taxes today at 22%, I know the rate, I don't know what it's going to be in the future, and I'm going to get all of my growth tax-free. So we are able to look at that, different options for them, look at their current tax, and help them determine, does it make more sense to do traditional 401k or Roth 401k, and the Roth option was a much better solution for them.
And that's becoming a lot more common now that companies are offering that Roth 401k component, which is a newer development. And so it's important for folks to know that, to be able to take advantage of it.
Yes, and tax-free, tax-free growth, tax-free withdrawal, pay the taxes today, get the money into the tax-free account. That doesn't always make the most sense, but it does for John and Betsy's situation.
Right.
And that's where working with an advisor, we can help you determine where should you be putting your retirement savings. But we can't do that until you pick up the phone and give us a call to schedule your complimentary consultation.
Well, I know that one of the things you're offering is this personalized tax report. So that's good. We'll go into more detail about that throughout today's show. But if you would like to take advantage and be able to come in and meet with Kevin and the team of Citizen Advisory Group to get help with your own financial and tax discussion about your situation, it's really easy. Simply call 866-630-1675. You're also welcome to take out your smartphone, and if you open up that camera app, you can point, click, and scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary meeting that way as well. We have a lot more to get into on today's important discussion surrounding taxes. Stay with us.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Retire Well. I'm your host, Kristen Oakley, here with Kevin Bucher, co-founder and financial advisor of Citizen Advisory Group. The area we are focusing on today to help you retire well is strategic tax planning. And Kevin, I'm really excited to continue this conversation with you, and I know you've brought some awesome props. I think visually that can really help paint the picture of what we're getting into today.
Yeah, we'll see. So it all comes down to something we mentioned in the first segment there is, you know, there's a game to be played, and when you play the game well, you can win. And when you win, that means that less of your hard-earned retirement savings are going out the door to taxes, right?
Yes.
So
less to the IRS, right?
Oh, I love that. Less to the IRS,
Yeah.
yes. So we have these three different options on where we can save money. And I think it's easy to kind of think about, okay, there's phases for what's going to happen as you're using these three different types of accounts. So what happens when you put money into these accounts? What happens while the money is invested in these accounts? And then what happens when you try to take the money out of these accounts? So when you're using a pre-tax or a tax-deferred vehicle like a traditional IRA, a 401k, a 403b, when you put money into these accounts, you actually get a little bit of a tax incentive to do so because you get an income deduction for the money you're putting into that
For
bucket.
that year.
Yes. So generally speaking, is that good or bad? Well, you know, we shouldn't answer questions generally because it sounds good,
Right.
and for some people it is, right? So we get a tax deduction. I would give that a thumbs up. A deduction of taxes is probably a good thing. While we're invested in the pre-taxed account, the money grows tax deferred. So I don't have to worry about paying taxes on my dividends and interest. I don't have to worry about the gains. So I would call that good.
Right.
But then when we take money from these accounts, now I have to reclaim that as income and I have to pay the taxes on the way out. I would call that bad, right? So good tax deduction, tax deferral sounds good,
Right.
and then tax withdrawals, taxable on the way out.
So we've got 2 thumbs up and 1 thumbs down.
2 out of 3, and I would say
Right.
2 out of 3 is not bad.
Right.
Okay, so the alternative to that is I can work with a tax-free account, like a Roth IRA or a Roth 401k. And to your point, we've had limited options historically on putting money into tax-free vehicles. So there's limits on how much you can contribute to a Roth IRA, but now they've opened up where Roth 401ks are an option where we can use tax-free contributions to the 401k accounts through the Roth. So there's more we can put into the tax-free. So thinking of those same three phases, when we put money into the tax-free, I don't get that income deduction I do like when I put it into the pre-tax.
Right.
So no income deduction, we'll call that bad. It grows tax-free. I have tax-free dividend and interest growth. I have tax-free capital gain or appreciation. And then when I take withdrawals from it, I can also withdraw from it tax-free. So no tax deduction, tax-free growth, tax-free withdrawal. Same 2 out of 3, just a different order.
Right. Yep.
Which one's better?
It depends, right?
Yeah.
Like so much in the area of personal finance.
Yeah, it really does depend. So I'll walk through a really fast example of a younger worker. So a younger worker who's maybe 30s or 40s is faced with this decision about going pre-tax or tax-free. And I like to look at it like this. There's 2 things. Number one, as a younger worker, I think it's safe to assume that you're going to advance in your career and your income will be higher in the future than it is today as a 30-year-old worker. No guarantee of that, but I think that's the American way that we strive to move up the corporate ladder and make more in the future. And when would you rather get an income tax deduction? By putting it into the pre-tax, when your income is lower as a younger worker or higher as an older worker. Well, an income deduction makes more sense when your income is high and you're in a higher tax bracket.
Right.
So from an income standpoint, a younger worker doesn't really need the tax deduction as much as they would benefit from the tax-free growth.
Right.
From an income standpoint.
And they have time on their side too, longer time horizon for that tax-free
Yeah,
growth.
so part 2 of that equation is how long do you have for it to grow? And do you want your money to grow for you tax-free, or do you want it to grow for you that's still going to be taxable? So if I'm a 30-year-old worker, again, assuming a 7% rate of return, my money would double for me every 10 years. So that's the math of that.
Right.
So if I was going to put $10,000 into one of these buckets, and I'm a 30-year-old, I'm going to leave it until I'm 70, well, that means it's going to double for me from 10 to 20 when I'm 30, to 40, to 80, to 160. So by the time I'm 70, my $10,000 contribution might be 170. So would I rather have that $10,000 in a tax-free account that I can withdraw it tax-free, or would I rather have it in a pre-tax account that is still loaded with all of the tax? I think it's a pretty simple answer.
Right.
That the 30-year-olds who are planning on advancing in wage throughout their work history should probably take advantage of the tax-free. But then as you advance in your career and your income shoots up, put the money into the pre-tax, which kind of highlights an important concept: diversification.
Yes.
I think we always think about it, diversification as how do we invest our money? But we really also want to have some diversification in how we're funded in the taxes. And we haven't even got to this bucket yet. And I don't know we'll get to it. But there's another option for where we put our savings dollars. But the reality is, when we get to retirement, it's really helpful if we have some diversification and we have money across multiple buckets.
Tax diversification, which I think a lot of folks, as to your point, they think of diversification, they just think of how your investments are diversified, but having a diversified plan when it comes to your taxes is really critical.
Yes, don't put all your eggs in one basket, and in
Right.
this example, all in one bucket.
Right.
All right.
Yeah.
So a quick example of that, clients we work with, Kathy and Marty, they retired with some pension income and Social Security to where they're in the 22% tax bracket today before they take any money from their investments.
Okay.
But like many of us out there, we've bought this pre-tax hook, line, and sinker, and 95% of retiree savings is in pre-tax accounts, and that's Kathy and Marty as well.
Right, because the majority of Americans have the bulk of their wealth in tax,
Pre-tax. Hasn't been paid yet.
And we were told that this was a good thing back when these accounts were created because supposedly we would be in a lower tax bracket in retirement. That's how it was sold.
So for Marty and Kathy, they're already in the 22% before we touch their retirement savings, and it's 100% in this pre-tax bucket.
Wow, yeah.
They had a large household expense that came up that wasn't supported by their income, so they had to take a withdrawal from their investments. They only had one place to take it, and it was the pre-tax. So that quickly pushed them from 22 to into the 30% tax bracket, where they're giving more money away to Uncle Sam than needed to be if they had proper diversification, and we could have chosen where we took the money from between these different types of accounts. So building tax diversification is important. If you're not there yet, there are ways to move money from pre-tax to tax-free, and we'll talk about that when we get into the next segment.
Absolutely. So important to know all this, and so much goes into having, this is why you need to engage in that proactive tax planning. And this is what you're offering folks when they call in today.
Yes, there's a game. We got to play the game, and winning the game for you will just mean something better. Better by paying less in taxes, having more in your pocket. And what would that mean to you? Would it mean a better quality of life? Would it mean more money to give to your friends and organizations? Better is just better, but you have to start playing in the game. So by calling today, our team at Citizen Advisory can help get you in the game and get you on the path to success.
Kevin, thank you so much. To our viewers at home, that number to call to get your very own complimentary tax analysis report is 866-630-1675, or again, you're welcome to scan that QR code and that will get you connected as well. When we come back, Kevin's going to dive into what do you do if you have a lot of your wealth and it's not diversified from a tax perspective. He's going to share some strategies right after this.
I have a bachelor's degree in education. I spent the first part of my working years teaching. I left the teaching world and went into a family business endeavor that eventually led me down to the financial services world. And there really is a lot of overlap between the two, taking comprehensive topics and breaking that into common sense, easy to understand framework, whether that was in the classroom or now in a meeting room with clients. There was a transition, but some of the skills from the education world transferred very well over into the financial world. By and large, people are very confused about the financial planning process, and oftentimes they kind of settle for the default outcome of that, of not really having control. One of my favorite parts of the process is putting the solutions together and then presenting that back to the client and seeing maybe some light bulbs going off to understanding things that maybe there wasn't a great understanding of before. Setting goals, working towards those goals, and helping them along this journey to having a more successful financial outcome. I do have an oversight role as well, where I'm overseeing other advisors. We work very well together in a collaboration where we bring different areas of knowledge and expertise to the table to really provide more comprehensive solutions for our clients.
Welcome back to Retire Well. I'm Kristen Oakley here with Kevin Bucher, and a very important conversation we are having today about engaging in strategic tax planning. And Kevin, I'm excited for you to share with our viewers. You had mentioned earlier, as we talked about how most Americans have the bulk of their wealth saved up in these pre-tax accounts. What can be done for them? How can you strategically move that money from the pre-tax accounts to the tax-free?
All right, so client example, George and Ann. And we see this on a fairly regular basis. So George and Ann were retirees. They retired fairly late in comparison to others. So they were able to defer their Social Security to where they both were getting a high Social Security benefit. So as a household, they were drawing about $88,000 a year of just Social Security.
Wow.
Which is a lot of Social Security income.
Yep.
And fortunately for them, that's enough for them to cover their household expenses. So they have retirement savings, but they're living off of just the Social Security. And when you look at the math of that or how Social Security is taxed, they currently don't pay any income taxes. So, we kind of celebrated that with them for a brief moment, but we quickly realized that, yeah, you're not paying taxes today, but your path looks much different. Because they had 100% of their retirement savings, which was about $1.5 million, in pre-taxed accounts today.
So they were sitting on a ticking tax time bomb,
yes,
one might say.
And,
right?
and that's going to go off whether you realize it or not. That time bomb goes off when you get to 73 years old. Because at 73, you have forced distributions from this pre-taxed bucket. They're called required minimum distributions, RMDs. You have to take money from this account. So here they are today, zero tax.
Right.
$88,000 of income pays their bills. When the RMD kicks in from their bucket, it quickly shot them up to 24%.
Wow.
So they're paying no tax today. They're going to go all the way to the 24% tax bracket when they get to 73, when that distribution kicks in. So what that tells me is anything less than 24% for them is a discount It's on sale because that's the rate they're going to be pulling money from this bucket from in the future. So we want to take full advantage of getting every dollar we can get out of this tax-free. We want to take full advantage of getting every dollar we can out at 10%, 12%, and 22%, because all of that is a lower rate than what they're going to be getting it out in the future. And that's before there's any potential tax increases down the road, right?
Right.
So how do you do that? We can't just take, oh, we don't want to pay the tax, let's put it into the tax-free.
If only it were that easy,
If
right?
it was that simple. So, but there is a way to start repositioning the pre-tax money into the tax-free, and it's through what's called a Roth conversion. There is no limits on how much you can convert. So they could convert all 1.5 million into tax-free, and they could do it all in 1 year if they wanted to. But there's a consequence to moving money from pre-tax to tax-free, and that is you have to pay the tax in the year you did it.
Right, and I don't think anyone wants to pay a tax bill, if necessary, on 1.5 million in 1 year, because that's going to be a pretty hefty bill, right?
It is. So by looking at where do they project to be in the future, and again, it was 24% for them. If we know that their tax rate in the future is 24%, we need to strategically convert everything we can for 10%, 12%, 22%, because those are the lowest rates that they will likely ever pay in their life. So that allowed us to restart to reposition quite a bit of their pre-tax money into the tax-free. Once it's in tax-free, it grows tax-free for the rest of your life. I can withdraw from it tax-free without having to worry about taxes.
Yep.
It also then passes to my beneficiaries completely tax-free, as opposed to it still sitting in the pre-tax bucket that I'll have to draw from later at higher and higher rates. It also transfers generations to my beneficiaries, still loaded with all the tax.
And then they only have 10 years to have to pay that tax bill.
Yeah, so the new rules of the Secure Act that were passed in 2019 and then revisited in the Secure Act 2.0, they've shortened the window of time that your beneficiaries have to deal with the taxes on these pre-taxed accounts. That's likely going to force the money out at higher and higher rates. So the more you can get out of pre-tax today into tax-free makes a lot of sense.
Which is why it's so critical, and this is such a timely conversation for you to be able to call and receive your very own tax report. So Kevin, thank you so much. I know you're excited to meet with more folks and help them in this way.
Yes, don't wait, get in the game.
Absolutely. Again, that number to call, 866-630-1675 to receive your very own complimentary tax report. Be safe, be happy, be blessed. We look forward to helping you retire well next week.